A very, very interesting afternoon. I mean, for those of you guys that are in LTMP, again, very boring day. There's not much to do before Jerome Powell speaks on an FOMC day here. We did see some movement in a couple of the individual names. We saw a little bit of drama with Apple and Google. We also saw some additional insight into what these new trade negotiation meetings are going to look like between Besant and China. They're really going to be preliminary meetings here. I think the market in general here is really kind of forgetting just how long it does take in order to get these massive trade deals done. It's not a day, a week, a month, a quarter. It can take a year or more in most cases to get everything finalized. That doesn't mean that you can't see some agreements made on certain things in the short term, but the totality of the agreement is going to take a significant period of time. Now, today, ladies and gentlemen, with Jerome Powell coming out and speaking, I mean, I saw, quite honestly, one of the stupidest things I've ever seen as it relates to monetary policy on Twitter today. Somebody was saying that Jerome Powell and the Federal Reserve is going to be cutting rates by 100 basis points, 1%. That was getting a lot of traction there. The Fed right now, guys, has no argument to cut rates. You have to think about what they've said in the past, how they are looking at the data right now, and it is very obvious when you look at how Powell, the tone of Powell as it relates to inflation, and kind of how they've been casting off to the side these growth slowdown fears, and then also not really paying they're paying attention to it, but the unemployment rate really isn't causing any, or having any meaningful moves right now for the Fed to act on that front. So yes, we did see GDP growth slow in Q1 due to the significant increase in imports that we saw, kind of front running a lot of these tariffs here, which again are going to create a little bit of a negative drag on GDP. We've heard from Besant that those numbers could be revised to the upside. It'll be interesting to hear what Powell has to say about that first quarter negative GDP print, as well as that declining PCE print that we saw, I believe it was last week there, of, I think it was 2.3%. So moving closer to the Fed's long run target there. Remember, PCE is the Fed's preferred metric of inflation, so that's really the one that you want to pay attention to. But with that, we also have those container shipments like just absolutely plummeting. And there is a lag. It's not like you put something on a container or a carrier there and then it's immediately to its destination. It takes about 25 days, I believe, for those shipments to get from China to the US, and an additional 10 days, so 35 total days to get from China to New York. So we are right kind of at the cusp of starting to feel whatever those effects may be, and that could cause those short-term price increases, which is what the Fed is really worried about. So the timing of everything here, again, the Fed's not going to be cutting rates. It's highly unlikely that the Fed cuts rates today. Right now, when we come over and take a look at the Fed Watch tool here, and just kind of seeing what the probabilities are for a rate cut today, it's 2.3%. I can refresh this. It's probably not going to move around all that much. And June is actually moving down too. Yeah, so 2.3% for today. We have 27.8% for June, and then July is when things start to move up a little bit. 55% probability for the first rate cut. Starting in July now. Now, we were talking on the private stream this morning with everybody in Less Trades, More Profits, which I do have a deal for you guys, which we are going to talk about in a second, that there is a potential bond trade brewing. It's not going to be like the other ones that I've called over the last couple of years here, where I'm bottom ticking and top ticking the movements in the bond market. A lot of the times either on the day or of the week of the tops and bottoms. Well, the last one was within, I think it was 3 days of the top and yields, bottom and bonds. It's not going to be like that just because you're going to see a short blip, I think, if you do see that short-term price increase across the board there, because what people don't realize when they talk about tariffs being inflationary, everybody, inflation's a rate of change. It's not like you can see a one-time price increase and then a year from now that data is now out of the equation, and then like CPI, PPI, everything just plummets. So you see the ECB cutting. Again, one of the reasons for that is that their inflation data doesn't account for shelter. Ours does, unless you're looking at Supercore, but you haven't really seen that much development on that side. But ladies and gentlemen, I hope you guys are ready for a very interesting day. Good morning. Watch your videos every day. Useful stuff. Thank you, man. I appreciate that. As you guys are filtering in here, if you guys wouldn't mind hitting that like button, costs you nothing to do it. Helps me out a whole lot, spreading these streams out here. Again, I'll have another YouTube video out for you guys this evening, recapping everything that Powell said, and then also going over everybody's favorite stocks as well. Make sure you guys are subscribed, turn notifications on. You guys aren't going to want to miss a lot of these videos here, because again, I feel like the main reason I started this channel like years ago was because I saw a lot of videos out there and I was like, I just don't think these people really know what they're talking about. So I still feel that way. You see things out there and you're like, what? But you hope the market goes bearish. I mean, honestly, I'm kind of down for that too. I would be very all right with the market selling off. Like, think about it. So this is what we've been talking a lot about in the group there, is like this move up over the last 2 weeks here was really fun. We caught a lot of epic trades. What was it? 750% on TSM. That was probably the big winner there. And then we had a bunch more in that 2 week period as well. But like, this is the liberation zone on ES. What we're looking at right here, this big blue zone, is the areas that we were trading at on, what was it, April 9th, I think it was? April 2nd. April 9th is when we got the extension, the delay, the 90-day pause. But when you look back here, this is also a prior all-time high zone, so we've had this level on our charts for a while, but to me, it's very difficult to convince me that it makes a lot of sense to start like longing things up at this area here, because like, why would new money flow back into the market when, ooh, this is getting a little funky over here? What's going on here? Like, there just isn't an argument to me that says markets continue up aggressively from here without a lot of new, really positive information for markets. Like, all right, let me phrase this better. When you have the potential growth slowdown in a Fed that's already worried about inflationary pressures, that have already said they aren't going to cut, so you have growth slowdown, earnings have been okay, but you still have volatility from a lot of these trade talks here. Why would you trade higher than where you were before the actual big announcements came out? Because you're technically you're actually still at a worse place now than you were back in here with the additional tariffs. Like, some of them have been walked back, but these were the exact areas that we expected the market. And if you guys have been paying attention to the videos, this is exactly where we said the markets were likely to trade up to and then start to pull back or consolidate and wait for that new information. Today is a big day for that new information, but we're not going to get a cut. We're just going to hear a little bit of a difference in the tone of Powell and everybody else here. Let's see. Yeah, exactly, Ryan. You guys get what you have with the Discord. Like, we're not upselling you guys. I've said for like months I was going to re-release the mastermind to everybody, and then I just haven't done it. Like, you can't buy it. Sorry. Like, I just don't care. But let's see here. Oh, you guys are slacking big time on the like button today. Uh-oh, ladies and gentlemen. Let's see if we can get the stream to 100 likes before we get the FOMC rate decision at 2 p.m. We have 7 minutes, and you guys are slacking big time. It's a big boy candle? What are they doing now? What are they? No, I'm serious. Like, today, if you're trading this, taking new positions ahead of Powell, being super active today, I think you need to take a really hard look in the mirror about what you actually want out of the markets, because today is a day that the people that are active in this market are just gamblers. That's all they are. We did nothing today. Less trades, more profits, man. Like, only looking for the perfect setups when they form, and that's it. Yeah, Daniel, it's, what do you call it? 2 p.m. 2 p.m. is when we get the rate decision, and some comments, and then we get the prepared remarks from Powell at 2:30, and then the Q&A, which is going to be really important. No, Trump's not doing anything to Powell. What we could see today, though, and this is something that I think people aren't thinking about, so those of you guys on the stream, getting a little insight here. Okay, so let's say the FOMC meeting goes well. Okay. You have kind of neutral comments from the Fed. Let's just say that they outline that they're getting closer to a decision on moving rates lower in the near future. They see the risk to GDP remaining low or even declining. The risks to unemployment to the upside are significant, and they don't think that there's necessarily going to be a massive increase to inflation or inflationary pressures coming in. You could still see Donald Trump come out in the after hours today or during the FOMC meeting and start screaming at Powell, and the markets react based off of that. So you also have to think about Trump's reaction to this too, not just what Powell says. Let's see. Right, exactly, Ryan. Yeah, and then we'll talk a little bit about the deal that I have for you guys that want to hop into Less Trades, More Profits in a bit. But, like, guys, I only have 5-star reviews for a reason. If you're not in there yet, I don't know what you're doing, but I'll talk about the deal a little bit. It's at the top of the live chat if you guys are curious. Bitcoin also, we haven't talked about Bitcoin today yet, but this is kind of performing very close to exactly how we've expected it to after this breakout that I outlined for you guys a couple weeks ago. So again, I don't have them on the charts now, but the two arrows were we were either going to run up into this zone right here, that was respected many times back in the end of last year and the beginning of this year, reject and trade back down to this 200 EMA and continue consolidating, or what we've already seen happen is a break to the upside, getting above that strategic crypto reserve high, then coming down and retesting the zone. Now, in an ideal scenario, you would have already come up and tested that $100,000 area before moving back down into this zone here. Because now if you do get that push to the upside, you still have to worry about that 100,000 area. If you retest it the first time and you reject, it makes it a lot easier to get through the second time. So you could end up seeing 2 retests of this area here before you end up getting that push potentially to all-time highs. We'll see. Also, again, we talked about this morning as well, that like the Fed buybacks and all that stuff. Something I told the group this morning, and I'll tell you guys here too. Whenever you see people on Twitter, let's just say, because Twitter is the best and also the worst place for anything finance, stock market related. Whenever you see people talking about reverse repo, or Fed buybacks, almost all of the time, don't even read it. It's nonsense. It's not what it actually is. Like today, people are talking about like the Fed buying back like 30 billion in bonds, and it's like they're not buying it back. They're buying new ones. It's at an auction. So how are they buying back things? Like how is the Fed doing a buyback at an auction? I don't understand that part of it. So then the second part is, well, a lot of these bonds that the Fed is holding have matured, especially on the short end. So they go out and buy more of them. That's just how it works. It's not like this stealth QE that everybody is talking about. So, plus, especially you have to think about the tone of the Fed right now too. Like they don't want to stimulate things right now. If they did, they'd be cutting rates, right? So just be careful with a lot of that stuff, guys. The vast majority of the time, it's nonsense. How would rate cuts directly affect markets? Running ads? Was there an ad? Oh, I'm not touching it. It's YouTube doing it. YouTube has this new thing where they're just like randomly placing ads places. I don't know why they do that, but whatever. Okay, so in general, if you look historically, the beginning of a rate cut cycle is bearish for markets. Here's why. The only reason why the Federal Reserve would have to come out and stimulate things is because the overall economic conditions that you're witnessing at that time are not good. So you'd have declining growth, unemployment going up, deflation. That's why a Federal Reserve or a central bank would start cutting rates. So it's almost like a waving the white flag or an admission that things are not great in a system, which typically causes a move down in the short term, which we kind of saw, but like not really. There are a lot of other factors this time. In the midterm, though, what it does is it increases the availability of money almost. It loosens lending. It doesn't really loosen lending standards, but it makes it easier for people, corporations to get loans because the interest rates on those loans are lower. So it'll stimulate growth in that way. That's really, I mean, that's kind of the most basic explanation of it right there. No, it's not. It's not because rate cuts are always considered late. It's that's just the Fed being, oh, here we go. Here we go, ladies and gentlemen. All right. Fed leaves rate unchanged. I want to see what Nikki Leaks has to say. The committee judges that risks of higher unemployment and higher inflation have risen. Oh, geez. Okay, so let's read this here. Although swings in net exports have affected the data, recent indicators suggest that economic activity. I want to read this on my computer. It's too. Hold on. Also, you guys are slacking on the like button still. If you guys like the stream, drop a like. Costs you nothing to do it. Helps me out a whole lot. Spreading these streams out here. Hold on. Uncertainty about outlook has increased further. Yeah, this is kind of exactly what we were thinking was going to happen. Inflation remains somewhat elevated. Somewhat. Okay, so back to this. Although swings in net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. I'm gonna call nonsense on that one with first quarter negative GDP growth. God, I don't know who wrote this, but that one I would call BS on. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation rate at the rate of 2% over the longer run. Uncertainty about the economic outlook has increased further. The committee is attentive to the risks to both sides of the dual mandate, so maximum employment and price stability, and judges that the risks of unemployment and higher inflation have risen. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. In considering the extent and timing of additional adjustments to the target range of the federal funds rate, the committee carefully assesses incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. Okay, so this is from the last meeting. So I'm reading this through, and it's showing like the differences between the last announcement and this one. So last time, remember, they announced the slowing of the runoff of the balance sheet. So remember, when the Fed says that they are selling, or how do they phrase it? Reducing its holdings of Treasury securities, they're adding supply to the Treasury market. So when they slow that down, it does create a little bit of a stimulative effect, but they're not increasing the size of their balance sheet like all of those geniuses were saying yesterday about the Fed buying all of those bonds. They're just replacing old bonds that they had. The committee is strongly committed to, so this is really all the same stuff. Yeah, there's really nothing new in here. So basically the Fed is saying that risks to the upside and unemployment have risen, same with inflation. That's really all we've gotten. Rate increases across the board? No. Unchanged. Azar, thanks, man. I appreciate it. Yeah, so that's what we have so far. Again, to be expected. Now what we have to look out for, now that we've had a very, very muted reaction out of the markets, as you guys can see here, is the tone of Powell. Now that they've said before, they've said it again, that the risks to the upside in inflation are significant. How significant? How does Powell talk about this? What about unemployment? Because what they're hinting at here is stagflation, which is the central bank's worst nightmare. Slowing growth, increasing unemployment, increasing inflation. That's because think about the tools that a central bank has at its disposal in order to kind of manipulate economic conditions. If you're in a recession, the Fed will lower rates and engage in open market operations to increase liquidity in the system. Both of those are stimulative. That can increase inflation, it can increase growth, and it can decrease unemployment. On the other side, if things are running too hot with inflation elevated, like we saw kind of 2022, 2023, inflation's hot, growth is, let's say, out of control, and then you have employment at aggressive levels, which, again, good and bad thing there. It depends on the frame that you're looking at it. the Fed can increase rates and also run off their balance sheet, which is selling the securities that they're holding. Now think about a situation where, so those are the two easy ones. Now think about when inflation is high, unemployment is high, and growth is slowing down. What do? You got to pick one. And that's what Powell was talking about at the last FOMC meeting, where they asked him, well, if inflation does spike and so does unemployment, which one do you pick to try and fix? And what they're saying is, are you going to, if inflation does spike in the short term, but unemployment does too and growth really slows down, will you cut rates or will you leave them the same or even increase them? How will the U.S. finance its debt if interest rates are high? Okay, one, no spamming. You're going to go in timeout. 1 minute. You get a 1 minute timeout here. But if, hold on, I got to view it again. How will the U.S. finance its debt if interest rates are high? Well, they'll just do it. Like they'll just sell bonds, guys. They have to. They have no choice but to do it. The problem happens here we go. The problem becomes when there's a debt spiral, when people aren't buying. Traders continue to see Fed rate cut likely by July. I would agree with that. I think June's the earliest, like we've been talking about over the last few months, that we could see one. Fed says uncertainty about outlook has increased further. Sell it, kill the market, sell it all. Arturo, yes. No spamming though, guys. Don't do that. Ooh, we're almost at 50 likes. We're 6 away. Thank you guys. Appreciate it. But yeah, so now that we've got the interest rate decision and those initial remarks, this is the Friday low that we're talking about here too. That's what this is. This dotted line, it'll go ding if we hit that. But now we're going to get the prepared remarks from Powell, which is basically him just reading that statement and then the Q&A. I would expect to hear a lot of questions about PCE, the first quarter decline in growth, because again, it sounds like the Fed, whoever their intern is that wrote this, needs to be fired because they said economic activity has continued to expand at a solid pace, and none of the data is really supporting that, except for like retail sales, kinda. But like with consumer sentiment that low, it's like a blip. Like think about it like this. The only reason why retail sales are as high as they are is because you have, I've talked about this in the past, and okay, before I say this, this is not a dig at women. It's just looking at the data, okay? Just, I feel like when I say it, you guys are gonna be like, oh, I wouldn't even have thought that. But people were yelling at me one time. I was like, okay, so women make up like 70 to 80% of the consumer base and also lean about like over like a majority Democrat. When you look at the 1 year inflation expectations for Democrats, it's like 7-8%. So you can then assume that a lot of those are going to be women, and if women are making up the significant portion of the consumer base, well, they're kind of in control there with what do you call it? With what happens with consumer spending. There's the Friday low. Be careful, VIX. Dude, I don't know. People are just too sensitive. I'm talking about data here. I just like quite honestly, you could interpret that the other way and just be like, oh yeah, women aren't, I don't know. One person made a comment and I was like, what are you talking about? So it's just getting a better insight into the consumer there. So if the vast majority of the consumer base is going to think that prices are going to be way higher in the future than they are right now, no matter how accurate that is, because inflation, I hate to break it to everybody, is not going to 7% this year, then it's going to change their purchasing decision. So right now, I think I pulled it up in yesterday's video. If you look at retail sales, let me grab it. 3-year chart's better. All right, here you go. So if you look at retail sales here, what happened? January, -1%, February, 0.2%, and then March, 1.4%. So you're seeing an increase in retail sales as people start to buy more now to get ahead of these price increases. That's what's been happening. But it can go the other way too, where people, because if you combine that with where consumer sentiment, where it is, which is in the gutter, down to like 2022 levels, like the low of 2022, they could just say like almost screw it and we're not going to do anything. you know? Tariffs and refinancing their debt at high interest rates will generate more inflation. It's not at like, the Fed really only needs the 10-year at like around where it is to be okay. Yields coming down, that's good. Like, it's not, that whole like refinancing all of that debt situation is not great, but it's not necessarily as bad as people have made it out to be, if that makes sense. Like, they really don't need, would it be great if yields were a lot lower? Yeah, it would be. But the problem that people are missing here with the tariffs is that they don't lead to long run inflation. They might lead to a one-time price increase, demand tanks, and then you see growth slow down. And if you don't have that demand, you also don't necessarily see prices go up. And also, if demand drops like that, guess what also happens? Companies have to either lower their prices in order to, it's a cycle here. So like if they're selling less things, widgets in general, well, then they're not going to be able to afford all their employees, which leads to unemployment going up, which slows down growth, which leads you into a kind of a recession here. So it does appear that a lot of this is deal making, and a lot of the nonsense that we're seeing is just, this administration is looking for a deal, but refinancing is even worse. No, obviously, like, it's not good. Like, I'm not sitting here saying that the situation the United States is in with its debt is a good thing. You gotta think about it like this, though, is that if the party keeps going and people keep buying our bonds and you have growth initiatives, you can outgrow a lot of that. The deficit spending, you can do it. It's a balancing act. It's not a good one. It really is not a good situation, but you can kind of continue the party going. Unemployment in the coming months? I agree with you there. I think in the short term, it's really going to come down to this situation with container shipments, because the only right now, the actual risk to prices moving to the upside is a supply shock. Like right now. I'm not talking about like 2-3 months from now with these tariffs. I'm talking about literally right like now. Is the supply shock from these container shipments being so low? And when they get here, we're going to see what's actually in them and be like, do we have all of the goods and services that people have demand for or not? And if we don't, prices go up. Do I think MicroStrategy will go higher? Well, if Bitcoin does, yeah. I've outlined the Bitcoin night, like I called this move for you guys up to this zone here. Then it was decision time if we were going to go take out the strategic crypto reserve high. I think now, like I said before, you got to be worried about that $100,000 level because you didn't test it on this move up. So you easily could go up, test 100K, then start to move back down. But Daily Pizza, I know you love your MicroStrategy, man. Just depends on Bitcoin. I like the argument with global M2. It's just the problem with that is a lot of the global M2 money supply increase is coming from China, and like what are they actually doing with that money, you know? So it's like the productiveness in terms of like assets with that global M2 increase. It's tracked it pretty well so far though, so you can't really call it wrong yet. So we'll see. And then again, I think now, I mean, we're 15 minutes away from Powell. Those of you guys that are looking to hop into the Less Trades, More Profits community there, I'll just kind of go over what you guys get. You guys get access to both or I'll go over the deal first, and then I'll talk about what you guys get. So it's my birthday this month. I feel like I'll give you guys a crazy deal. Also, when you're in there, it's not like I'm upselling you all the time. What you see is what you get. You get 50% off the first 2 months. So it's literally $1 a day. For those of you guys that want to hop in, the link is pinned to the top of the live chat there. That's the deal. 50% off for the first 2 months there. So it's $1 a day. Now, here's what you get. You get access to both full-length educational courses, so the Day Trading Mastery course and the Swing Kings course. You get the full lists every single week and then throughout the week of the stocks and cryptos that are about to explode before they do, the pre-market plans, the daily private live streams, the big macro research reports, the weekly stock macro research reports, the single stock research reports, the pre-market plans I think I talked about too, and then you just have direct access to me to answer all of your questions. That community, guys, again, I only have 5-star reviews for a reason on it. There's a lot of nonsense out there with people just like not doing it. I built this because I was like, oh, this is what I would have wanted in terms of every element of being a market participant, trading, long-term investing when I was first starting. And that's why everybody has so much success once they hop in, because it's once you see it, you can't unsee it. Well, especially on the swing trading side. So if you guys are interested in that link is at the top of the live chat there. Use code May. The code is May if you want to hop in. So it's 50% off your first 2 months. That's the special deal. You guys got questions about it? Let me know. If not, just go read the reviews. They speak for themselves, man. Only 5 stars for a reason. Secret charge, no. All this would make the market rise. That's why Tom Lee and others know the market will reach new highs with the American economy. Not if you continue to see the volatility. You will never get a better deal. Thanks, Michael. Appreciate that, man. Yeah, it's a sick deal. So for those of you guys that still need to hop in, go for it. We'd love to have you in there. It's a great group. Great group of people. The daily live streams are always fun. Even when the market's slow, we're just in there having a good time. Michael's just peer pressured people to join. But all right, so we've got about 14 minutes to go here until we hear from Powell. If you guys miss it, I'll have another YouTube video out for you guys tonight, recapping everything, all the important stuff that Powell said. So again, make sure that you guys have notifications turned on for the channel. Also, over half of you guys that are watching the videos now aren't subscribed, which is good. I mean, that's good. That means I'm doing a good job as a YouTuber, but you guys should subscribe if you like the videos. So, yeah. And if you're challenged, I'll throw the link in here for you guys too for what we were just talking about. So, there you guys go. He even shows off his new yacht. Oh, this one? This one? The boat? The boat that I say is my boat, which is just not my boat. Yeah. This new apartment's way better than the other one. Every day I wake up in this one and I'm like, oh, I love this one. This one's so much cooler. So, all right, team. 13 minutes to go here. We've covered a lot of everything. If you guys have any additional questions, just let me know. That's what I'm here for. If you have a super pressing question, send a super. You don't have to, though. I like yields down. I'm a fan of that. Oh no, the market's tanking to Friday lows. Oh no. It's almost as if when we were on the stream this morning and yesterday when I said, hey guys, we probably don't want to be touching anything before Powell so we can get more information. Let the charts develop for us. Oh, the dinner cruise boats? It's not a dinner cruise. It might be. I don't know. But it's like I think it's a tour. Maybe they do parties on it too. I bet on one of them. They're fun. Freezing when it's cold outside. Yeah, dude. It just in general, Boston is just freezing in the winter. It makes me want to move to Florida every year. Every year. Where's Tesla right now? Tesla's, I mean, this was my favorite look going into this week, and they're going to invalidate it here. We're not going to be able to touch it. That's no fun. I mean, that's one of the best parts about the system, too. It's like, we have an epic setup that we're looking at there with Tesla. If it doesn't validate, cross our levels, we don't touch anything. Nothing gained, nothing lost. We just keep waiting for those great setups to form. Oh, this is a good one. Romeo, I remember that pizza trade, dude. That was an epic one. I got screwed on it because of the expiration and the buyout stuff, but like, hey, you guys was short dated. That was the 5,000% trade. Pay attention to pay a premium. Had my first 100% trade in the Discord. Helped me grab a 5,000% gain since. So much better than I would have expected. Love it. Thank you, man. I appreciate that. Yeah, it's a great community. So yeah, everybody gets their first 2 months now. 50% off with code May to hop in there with us. I mean, if I was a new trader, or even just like, it's for everybody too. Like, you guys hear the stuff that we talk about in the videos and in the, in this stream too. I think we're going to bring back the Friday public streams too. You guys get that stuff every day. So A lot of the time. Recently, it's been a little slow, though, just because, like, there's nothing going on with the market. We just sit there and are like, nothing, no thanks. Unless it's TSM and we nail that for 700%. And we're like, okay, we're done. All right, no, we're done. We don't need any more. And sightseeing cruises. They got a lot of cruises. Market's popping back up here. Let's check and see what's going on the news feed, see if there's anything important for us. I doubt it after the former Fed Vice Chairman Rich Clarida. Market's already pricing 40 to 50% chance of a recession. Yeah, but they could play some games with that first GDP print, revise it up to being positive, and then you get into the third quarter of this year. It's like they can do a lot of nonsense here. U.S. pushes nations facing tariff to approve Musk's Starlink. Oh, of course they are. Of course that's what's going on. Robinhood said to plan blockchain to trade U.S. assets in Europe. Ooh, that's hold on. That's not the right one. It's not. Is it BYON? No, there's another one. It's like T0. TZRO. TZ is this. Yeah, it's not. It's OTC garbage, but I just thought one of those like tokenized security stocks would move off of that. I do not stream on Twitch. But yeah, you guys get the YouTube links every day in there. So, yeah, there you guys go. Just YouTube. But I don't really stream ever. I make videos for you guys every day. I think we'll bring back the Friday market open public streams. I think we'll do that this week. We'll bring those back for you guys. Those are fun. Especially when you guys just watch. See, it gives you guys a nice little look sometimes into what we do in the private group. Like, we'll come on Friday sometimes, especially when it's post earnings, and I'll just hand out like the filthiest 500% trade ever. People will be like, what? It's like, yeah, it's what we do. That's what we do in there. Vic's cooking videos? Dude, I could make 3 cooking videos and you guys would be like, oh, that would be it. I literally only make like 3 things. Sense to also restream on Twitch to get more viewers? No, it wouldn't. I don't have a following on Twitch. I have a YouTube following. But yeah, we got 8 minutes to go here. The car giveaway. Dude. You guys, I'm surprised nobody's asked me about ankles yet. Anybody that's new to the channel is going to be like, what are you talking about? It's like, don't worry about it. It's fine. I'm trying to avoid it at all costs. We got 2 Teslas up here. We don't need this. How's Google doing? Oh, that's not good. I'll give you guys a freebie. You trained through the live chat. Dude, we did that for like 3 days with the Apex eval. And I was like, we're not doing this anymore. This was just boring. Like, you guys were terrible. I'll give you a freebie here. Meta. Meta looks nasty for next week. Or this week, too. You give this like 3 more days. This is a nasty looking setup. I mean, you would have to go through the course videos to understand what to do with it. But this is looking like A+ here. I also own a boatload of Meta shares. Elgene. Potty mouth. Lizard skin. Yeah, they do have rumors about me being a lizard too for calling stuff before it happens. Usually with the bond market, but it's not being a lizard. It's just, guys, I've been doing this forever. Like, I get somebody like comments on my YouTube channel sometimes where it's like, what are you, 12? And it's like, why, do you want to kiss? But it's like, guys, I'm gonna be 26. I've been doing this since I was 14. Like, I've been doing this for a while. I know it doesn't look like it, but I've been here for a while. And I'm not showing you my ID. The pearl necklace. Dude, I wish. That thing, I love that thing. I still need to get another one. I forgot about that. I forgot about that. I like this movement in bonds here. Lizard confirmed. Yeah, everybody thinks I'm a lizard. But I'm one of the good lizards. I help you guys make boatloads of money in the market all the time. All right, 5 minutes to go until we get to hear from Mr. Jerome Powell. Ooh, hold on. Is this gonna... All right, we have to also... Hold on. Yeah, Discord's gone now. Good. All right, and then we have to turn on this. See, I think this is the first one. Do you guys want to see Powell, or do you want to see the market? I would assume that you guys want to see the market, not Powell. So we'll play the audio of Powell, but we'll have the market for everybody so you can click through and stuff. I think that makes more sense. But yeah, shout out to you guys hitting the like button on the stream here, and those of you guys that are supporting the videos there, dropping likes, dropping comments, I appreciate you guys. That we're growing pretty fast now on YouTube, which is cool. So I appreciate you guys. I'll have another really good video off for you guys tonight. We're stepping up the thumbnails too. I was working on one last night. So again, make sure you guys have notifications turned on for the channel. If you guys see a video and you do like it, like it. If you don't like it, tell me, or dislike it. But then also tell me why you don't like it. Music. Oh, you guys can hear it. Sorry. Oh, I forgot. Hold on. I just had the music on for a while. Uh-oh. YouTube's gonna hate me. Sorry. My bad. Because OBS is weird. If I mute it, even if I mute it on my computer, it still plays through. Sorry. YouTube's gonna ban me now. Okay, maybe no more YouTube videos. Yeah, sorry, guys. I was like, music? What are you guys talking about? Then I was like, oh, whoops. I always forget that. Yeah, markets, I mean, this is unchanged. This is ideally what we want out of the market today, guys, is nothing. Well, I kind of want it to drill to the, you guys can kind of see here, this. I want us to come down here. So we have some more meat on the bone for some swings moving to the upside. But if not, we're just going to sit on our hands, preserve capital. There goes my monetization. Whatever, dude. Whatever. I think I'll be okay. I think I'll be fine. Oh no, YouTube demonetized my FOMC stream. What am I gonna do? Did you get that in the background? All right, yeah, 3 minutes to go until Powell. It might be loud. I don't know. It's OBS. We're going to have some. We're going to try this. We need Vix to freeze. We're not doing that. We're absolutely not doing that. Facebook, though, looks filthy. There was another one we were looking at today. I think it's Docu, but I don't really like Docu. That one's a weird one. That one's a strange one there, guys. So, yeah, let's see what we get today. We got the... What do you got? Q&A. Coming up in 2 minutes here. What color ties are you going to be wearing? Is it purple? Purple tie is usually good. I feel like he's going to be frustrated. He's like, I'm over this. Yeah, so we'll see. We're just waiting now. 2 minutes to go until we listen to Powell. If you guys have questions during the stream, just drop them in the chat. I'll answer them. Or I'll answer them in the video tonight because everything will be answered when I post the video. Teal. Ooh, interesting. Yeah, 1 minute to go here. Happy birthday, Vix, and show those ankles. Oh, thanks, man. Thanks for treating me like an object on the internet. I appreciate that. Thanks, guys. Rates held, bro. No movement. Guys, what do you think we've been doing over the last 30 minutes? Guys, of course we know that. Do I need to put a banner that's like, Powell, no change? All right, folks, here we go. Ooh, Echo. He could just dress like Barney the dinosaur. We should put a poly market on that thing. All right. Ooh, I don't see him yet. Once I see him, I'm going turning off my mic and we're going to go listen to Powell here. Still asking for ankles? I guess, man. I guess that's how it goes. But yeah, team, keep smacking that like button on the way in. Let's see if we can hit. We're 40 likes away. Oh, here we go.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmerose of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, Labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And, we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
John L.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive, because we actually don't know what the right response to the data will be until we see more data.
Colby.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
You know, so first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, you know, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, you know, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. but they haven't materialized yet. They're really not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that you know we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And you know, we dropped out of the network of greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And you know, the risk is if you go for things that are really not on your mandate, you know, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. You know, what we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, you know, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our, but I can see how, you know, maybe people found that confusing, and you know, we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So people they're worried now about inflation. They're worried about the you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. And we don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great, and just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risk to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. But what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses, and so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting, and so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right, ladies and gentlemen, that was the May FOMC meeting. If you guys have been paying attention to all of the YouTube videos and earlier on in the stream, Powell basically said exactly, like almost to a T, exactly what we expected him to. There was a little bit of a curveball in there when he talked about, not necessarily PDFP. We kind of knew that he was going to downplay the effects of downplay that first quarter negative GDP print, which he kind of did, and then also focus in on the risk to the upside in inflation there, while also kind of guiding towards that potentially stagflationary environment. But that one curveball was, there's a path with no rate cuts this year. So I'll have a YouTube video out for you guys tonight, not only breaking down everything that was, all the important things that were said by Jerome Powell today at the FOMC meeting, but we're also going to talk a lot about some of your favorite stocks here, Palantir, SoFi, HIMS, maybe NEO. We'll see if there's anything important on NEO here today. So again, make sure you guys are subscribed to the channel, have notifications on so you don't miss these. But yeah, very, very interesting meeting there. That tweet was also hilarious. That was the one that I was looking at there for a second. But yeah, for those of you guys that want to hop into the Less Trades, More Profits community with us there, again, we kind of outlined everything that you guys get in it. I can do it quickly now. This is probably the best deal ever for May. 50% off, not just your first month, but your first 2 months. It's $1 a day. There's only 5-star reviews on there for a reason, guys. And then you guys get access to both the full-length educational courses, the private daily live streams, the full watch list of stocks and cryptos that are about to explode before they do, pre-market plans, the big macro research reports, and then also the weekly market research reports, as well as the single stock research reports, which I just gave you guys one, a week and a half ago? That one's already up nicely. So that's gonna be a really interesting one. They had earnings this morning, or last night, this morning too. So you guys want to see which one that one is? Make sure you guys hop in there. But yeah, that code is May. That gets you your first month or your first 2 months for 50% off. Links at the top of the live chat there for that one, guys. But yeah, YouTube video out tonight. Very interesting though. Very, very interesting across the board. We didn't really get that much new information here. Again, we're still kind of chopping around at this liberation zone. But I'll have a lot more thoughts for you guys in the video. It's probably going to be out around 5 or 5:30, maybe 6. I don't know. We'll see. We'll see. I'll get it out as soon as I can for you guys. But guys, have a great rest of your day. Make sure you guys hit that like button on the way out. And then again, another shout out to you, those of you guys that have been watching the YouTube videos, supporting the channel, dropping likes, dropping comments, everything. It helps a lot. We're growing fast over here. This is going to be fun over the next however long we're doing this for. So glad to have you guys here. We'll see you in the video, and then we'll do another. I think we're going to bring back the Friday morning public stream, so we'll have that going for you guys too.